The broadcast is now starting. All attendees are in listen-only mode.
Good morning. This is Marcus at Insurance Agency Marketing Services. Wanted to welcome you all this morning. Joining us on the webinar this morning is Casey Lane, Vice President of Sales from North American. Product release earlier this week was the North American VersaChoice 10 in California. He'll be covering that product as we get started this morning. But what I'm going to do is cover some information on insurance agency marketing. If you do have clients come in the office this morning, we are recording this webinar. So I will go ahead and pass this out. If you want to, if you do get pulled away this morning, I will send you a copy of the webinar so you can go back and cover whatever material you might have missed. Any questions that do come up, please feel free to type those in as we go through. We'll be more than happy to answer those as we go through. Again, my name is Marcus Solar. Let's go ahead and get started this morning. I'm one of the annuity directors here at Insurance Agency Marketing Services. At Insurance Agency Marketing Services, we do have business builders to increase your capital. These business builders are referred producer program. You get $50 when you refer a person to Insurance Agency Marketing Services and they contract through our office. You get $100 more when they start to do business, and you get money when they continue to do business. Here's an example. If you refer somebody to us, they do $1 million, or you refer 3 people to us, they do $1 million. You get 20 basis points. That's $6,000 that goes back into your marketing account. What my producers do with that money is they tie that back into their marketing budget, which pays for their advertising for the up and coming year. Again, we have the marketing reimbursement account too. For every $100,000 in premium for single premium life and annuity premium, we put $100 into your marketing reimbursement to help cover costs within your day-to-day business expenses. We do have the new producer bonus builder program. It's $100,000, $300,000, and $500,000 level. This is for single premium life and annuity production for the first 180 days. You are with Insurance Agency Marketing Services. It is a way for us to say thank you for joining Insurance Agency Marketing and to help you get off the ground with either some business building pieces like a 2-year producer website at the $100,000 level, or different ways to keep your pipeline full, whether it's a Social Security program and a 3,000 piece mailer, or mentoring and seminar coaching by 2 of our top producers, either Matt Gill or Dave Pimper, at the $500,000 level. We do have some of the best back office support here at Insurance Agency Marketing. It does save you time, so it allows you to stay in front of your clients and do what you do best, helping them plan for their retirement. We help you work smarter, not harder, with case design assistance. We have forms at your fingertips. We have top sales expertise and coaching, and we have paperless contracting. We do have creative marketing solutions through our marketing area as well, whether you're looking for turnkey solutions, digital solutions, whether that's email marketing consulting, digital marketing strategies, any of these pieces through our marketing area, you can contact Andrew or Jacob here at our office at 800-255-5055. They would be more than happy to help you no matter where you are in your advertising strategy, whether you're just starting to get into the business or you've been in business for many years. They'd be more than happy and welcoming to help you achieve that next level. We do have our insurance agency marketing website that can assist you 24/7. And on weekends, when we are not in the office, we have forms online. You have access to quoting software. You have accessibility to rates to see what the rates are, index options for your clients, etc. So again, this is available for you 24 hours a day, 7 days a week. We do offer to our producers that are licensed and writing business through us, for those reps and insurance-only agents out there in the field that are looking to help their clients with retirement income planning. We offer the Retirement Analyzer software. Helps you help your clients answer questions like how would it affect my family if I die prematurely? How can I retire safely without running out of money? This is a great planning tool to help you sit down with your clients. The nice thing about this software is that you can adjust it annually. So when you do have those annual meetings with your clients, you can adjust it as their life changes. It's a great foundation piece to deepen that relationship with that client moving forward. A great review piece to go back to on an annual basis and really deepen the relationship not only with that primary client, but with their children, relatives, etc. So it really helps you grow your business as well. We do have insurance agency marketing, wealth management, another way for you to increase revenue, build that client retention, just like Retirement Analyze, and strengthen those client relationships. Charles Herring, Mike, and Joan work this piece of the business with insurance agency marketing services. If you are considering getting your Series 65, they will be more than happy to talk to you about that. Again, you can reach them here at the office at the same number, the 800-255-5055. Certainly do appreciate and welcome any questions or calls within that avenue as well. So please give them a call if you have interest in obtaining your Series 65 license. We do have an industry recognized life and annuity academy. This is a 2-day producer training. Our next one is going to be actually in September. It is sponsored by and paid for by Insurance Agency Marketing. We bring in 4 of our top producers. We cover every topic within the industry. We're going to be talking about business insurance concepts, some of the best income writers within the industry, wealth transfer tools like Retirement Analyzer, industry threats and trends, and our top producers are actually going to talk about what works well for them, what doesn't work well for them, how they keep their pipelines full. So there's several different tools that they will be sharing with you and face-to-face time as well within our Life and Annuity Academy. Again, this is going to be held in September. We don't have a date as of yet, but if you'd like some more information on this, I will certainly give you a call after the event this morning, but that's coming up in September. We do have our 2019 Marketing Summit coming up. That's going to be at the Ritz-Carlton down in Naples, Florida, August 25th through the 29th, 2019. The invitational period or the qualifying period is going to be January 1, 2018 through June 30th of 2019. The exciting news behind this is any business right now that you do through North American for July and August, you get double production credits towards our 2019 Marketing Summit. So that's going to be an excellent trip down to the Ritz-Carlton in 2019. So at this point in time, I'm going to go ahead and turn it over to Casey Lane. We have the privilege of having him on the call with us this morning. Like I said, he is the Vice President of Sales through North American companies. He's been with them for, I believe, and you can correct me, Casey, but I believe you've been with them 10 plus years. But I've known Casey for a very long time. He's going to be covering the VersaChoice 10 product that was released earlier this week in California. So go ahead, Case.
Thank you very much, Marcus. Hey, two quick things. One, just make sure I'm on that invitation to the Ritz-Carlton. I want to make sure I'm at that event. And 2, yes, it is 10 plus years. It's actually I am on my going on my 20th year here with the company. So definitely been a long tenure here. And I keep telling my boss the only way you're going to get me to leave is if you tell me, Casey, you're no longer needed here. So I plan on retiring with North American Company. Marcus, can you see my screen there? Is my screen up and running now?
Yep, I see it.
Awesome. Okay, thank you very much for the introduction, Marcus. Thank you, folks, that are joining us here on our call today on behalf of myself and all of the other employee owners here at the North American Annuity Division. Obviously, you folks are independent agents and you work on commissions, so you're not making money unless you're in front of clients and prospects. So for you folks to take 45 minutes out of your busy schedule and away from those clients and prospects is certainly very much appreciated. And I know Marcus indicated already this is being recorded, so if any of you do have to leave early to go write some North American annuity business, by all means, you go right ahead and listen to this thing when you get back after those appointments. Marcus, thank you and Insurance Agent Marketing for having me on the call here today and giving us an opportunity to talk about this wonderful new product in California. More importantly, thank you guys for being a true partner with North American Company. So obviously, Marcus and I want you folks to get the most out of your time here with us today. So I have just really one simple piece of homework for you as I'm going through the presentation. What I want you to do is I want you to think about your database of clients and prospects. And if a client's name or a prospect's face pops into your head for whatever reason, whatever it is I'm talking about at that particular point in time, I'm going to encourage you to write down that individual's name right then and there. Because I guarantee if you're anything like me and you try to wait till the end of the presentation, you're going to forget who it was you wanted to talk to and what it was you wanted to talk to them about. So my goal here is when we're done today is each of you has 3, 4, 5 names of clients or prospects that you can reach out to and talk to about the VersaChoice Index Annuity. All right, so I don't know if you guys have noticed, I'm assuming you probably have, it's kind of a rhetorical question, but hey, you know what? Rates have actually been coming up a little bit here over the last 18 or so months. Now I say a little bit and coming up, and that is true. We still are in a not necessarily historically low interest rate environment, but we are still in a very low interest rate environment. But the good news is we've seen just a slight increase in rates over the last 12 to 18 months. And because of that, I know as a carrier, and I think as an industry based on statistics that we've seen, and I can't speak for IMES, I don't know if this is occurring there, but I think because rates have slowly been moving up a little bit, we're seeing more of a shift in sales of our index annuities as accumulation or wealth building sales versus income type sales. Obviously, lifetime income is still hugely important to a lot of clients and a lot of prospects, but I think we've seen just a slight shift in the focus and where we're seeing premium dollars go, and that's to more of an accumulation type sale than necessarily an income sale. And you probably have clients and prospects that are in both of those categories. Some clients don't need lifetime income. They've already got pension plan. They've already got great Social Security. Maybe they're inheriting some money, so they just don't need the lifetime income plan. They're just looking for a safe place to put money where they can't lose it due to any negative market conditions. And on the flip side, you probably have clients that need as much guaranteed lifetime income as they can possibly get. Well, here's the good news, folks. With the VersaChoice product, you're going to get a little bit of the best of both of those worlds. So we're going to talk about the VersaChoice product in 2 specific topics today. We're going to talk accumulation, and we're going to talk about guaranteed lifetime income. So let's talk about the new VersaChoice product. By the way, this is new in California. Again, just rolled out here earlier this week, the 17th, so just a couple days ago. It's been on our books just since October of last year, so it is not only new for you in California, but it's also our newest index annuity product. And here's some staggering statistics for you folks. Usually, when you roll out a product, it takes 3, 4, 5, 6 months to get some decent momentum build up before you start seeing some significant sales. This is already our number 4 selling index annuity at North American. And if you've done business with us for a while, you know we have a fair number of products on the books. This is already our number 4 selling product. This is our fastest growing in sales terms of any of our index annuities that we've ever rolled out. It has gotten more premium in this short of period of time than any other product has. So I can't tell you it's our top selling product because it's not, but it's only been around for about 9-10 months now, and it's already moved up to number 4. So the question I get most often with any of our products is, hey, Casey, who is a prospect for this contract? Who should I be talking to? Who should I be approaching to talk to about the Versa Choice product? And it's in the two topics I mentioned we're going to discuss. One is somebody that's looking for just as much potential accumulation as they can without the risk of loss of principal, or a client that's maybe looking for some strong guaranteed lifetime income. They need to fill that income gap. Those are the two prospects you're going to find that are going to be candidates for the Versa Choice product. So let's start on the accumulation side. And it's a pretty simple, pretty easy story. And actually, we've made it as simple as we possibly can from the aspect of, hey, we don't have 15, 16, or there's not that many anyway. We don't have multiple indices to choose from, right? We don't have the Dow Jones on this strategy. We don't have the Russell 2000, the S&P mid cap. There's no gold strategy. There's no Euro stock. Folks, we've made it as simple as possible. You're going to find that the indices that are available to allocate premiums to, it's the S&P 500 family. S&P 500. If you ask your client, hey, do you recognize the S&P 500? I would bet 9 times out of 10, they know what the S&P 500 is. They see it every day. They hear it every day. You see it on the ticker tape on your TV, on the news. Most everybody's familiar with the S&P 500. So we don't have any proprietary indices. There's no exotic crediting methods here. S&P 500 only. And what you see on the screen are the rates that are currently available on the Versa Choice product. Now you'll notice that there is a premium band. 75,000 and higher gets you certain rates. 20,000, which by the way is the minimum premium on the product. 20,000 to 74,999 gets you the quote unquote low band rates. And I'll just give you a second to take a look at these things and digest them. Again, S&P 500 family only. So there's several indices available in the S&P 500 family. So we do have the standard S&P 500. We've got the S&P 500 multi-asset risk control index, volatility control strategy, and the S&P 500 low volatility daily risk control. So 3 different indices within the S&P 500 family. Now, I do want to point out a couple of things too, and you might be thinking, well, Casey, okay, so where does the accumulation opportunity come in here? I mean, the rates are very competitive. I'm not going to say they're the highest rates in the industry, but they are very competitive current rates. I highlighted 3 of them, and the reason I've highlighted these 3 is because these 3 strategies, these 3 crediting methods, are all what we would consider uncapped crediting strategies. There's no cap to the upside. Unlike here, the annual point-to-point cap strategy on the S&P 500, currently at a 6% cap on the high band and 5.25 on the low band. Again, you look back 12 to 18 months ago, they might have been sitting at 4%, 3.5%. We've seen an increase. So those are some nice caps, but these particular crediting methods here, these 3 are uncapped strategies. Now there is going to be either a participation rate, as you see here, 45% participation, Mrs. Client. You will get, if you allocate premium to this strategy, you will get 45% of whatever that index does over the course of the 12 months of your contract. Or on the S&P Mark V strategy, here is a margin. We use a margin, or you might be familiar with a spread design. Mrs. Client, there's a 0 margin on this strategy if you have more than $75,000 of premium, which means if that index actually returns, let's say, 7% this year, if you have over $75,000 of premium and you had monies in that strategy, you're going to get 7%. There's no margin to deduct prior to crediting gains. Very, very competitive. Again, these rates, I can't tell you they're the highest in the industry, but the one thing that we definitely need to keep in mind also is just because a company may have, and here's the common one, let me just give you an example. We know there's other companies out there that have a slightly higher participation rate on the S&P 500. Maybe they've got a 50% participation rate. Maybe it's 52%. That's higher than 45. So does that mean you should sell that one because it's higher? It's higher today. Hopefully your client, they're purchasing these things for the long run. They're not going to be in this thing just for a year. And keep in mind, every single company every single contract, there are contractual minimum guaranteed rates, right? So anytime after the first year, any company can drop those renewal rates to anything they want to, as long as it meets the contractual minimum guarantees. Now, I'm not saying other companies do that, but again, keep in mind, and the thing I want you to discuss with the companies you're doing business with is how have you treated your in-force policyholders when it comes to their renewal rates? Because this is 1 year of many that client's going to be in that contract. The bottom line is you want to be doing business with companies that are going to treat their in-force policyholders and have treated their in-force policyholders over the years as fairly as they possibly could. So do your own due diligence. Make sure that you are asking companies you do business with for renewal rate histories on some of their products or some of the business. And guess what, folks? If they don't share that, if they don't have that information available, there might be a reason that they don't have it available. So I'm going to get off my high horse of renewal rates. Again, this is a great accumulation product, and I do want to share a screenshot of an illustration here for you. Now, what I've done here is, and by the way, this is one page of the 14 or 13-page illustration that is available on our website. So I allocated 100% of the premium here in this example to that S&P Mark V index, where there was a 0% margin. So I just wanted to show you, if you allocate all in to this one strategy, here's what's going to happen. So what we do with our illustrations is we use the NAIC model illustration regulations. So we're going to look back over a 20-year period, and we're going to show you the worst consecutive 10 years of the last 20 years. We're going to show you the best 10-year consecutive period of the last 20, and we're going to show you just the most recent 10-year period and how this thing would have performed over the course of those 10-year scenarios. So here's the summary right here, and I'll highlight these. I'll make these a little bigger. So again, all into this one strategy. Most recent 10 years would have averaged 5.88% interest credit per year over that 10-year period. If we look at the highest 10 years of the last 20, we would have seen a 7.16% average annual interest credit. And if we look at the worst 10 years of the last 20, 4.21%. So what does that mean, Casey? Am I going to get 7? Am I going to get 6? Am I going to get 5? You know what? We don't have the crystal ball. I don't know. I can't tell you how this thing's going to look going forward 10 years. What we could assume is that it's going to probably fall somewhere between 4 and 7%, between the highest and the lowest. That's probably what's going to happen. Now, and again, some of you might be thinking, well, God, Casey, I just got an illustration from a company that showed 9.6% on the highest 10 years. So that's obviously better. Again, it is better. These illustrations are all based on the current rates and assuming that those rates stay exactly that same throughout the life of the product. And again, as you know, carriers can change those renewal rates. So yes, I do like illustrations, but I don't like illustrations because people, it seems like, are always searching for the best. Who's got the highest rate here? That's got to be the one I'm going to go with. Again, keep in mind renewal rates and the long term. Now, I want to show you another strategy here. I showed, again, this is all your eggs in one basket. And we preach, what's the saying we preach? Don't put all your eggs in one basket, right? So the next screenshot is going to show you just kind of a blend. I just did a 50-50 blend in between two different strategies on the next screen. But what I want to do here is I want to count, just for the heck of it, there's not a lot of them, but count the number of total years where we see 0% interest credits here. And I've already done it. So as you're glancing through all of those scenarios, you're going to find that there's 4 years between all of those scenarios where there was a 0 credited to the client's contract. 4 years. That's not a lot, but I want to show you that gets even better on the next screen. So here is a blend of the Mark V, which we just saw, 50% in that strategy, and then also 50% in the S&P 500, that participation rate uncapped strategy. So now what you're going to find, we blow up our returns again, pretty similar type returns, not quite as high in each of those scenarios as the last one, right? So 3.7 to 6.2, 6.25. So very similar type returns. But again, quickly count up the number of zeros that you see here in this scenario, in these, using this blend over those 3 different scenarios. and I'll make it easy for you. It's 2. Again, doesn't sound like it's a big drop, Casey, but more than half of the decrease in the number of zeros that your client's going to see on their statement. So my whole point here is, yes, you may see going in all with one strategy is going to illustrate the best, but take a look at diversifying amongst the different strategies, amongst the different crediting methods. Do some blending, because you know darn well that no one strategy, no one indice, no one crediting method is going to be the best one year over year, every single year. So you might be asking yourself, and I get this question a lot, well, Casey, which is the best? Which one should I allocate to? If I had the crystal ball, I'd tell you exactly which strategy to put all your premium in. But then again, if I had the crystal ball, and I'm sure Marcus would agree, I wouldn't be on this webinar probably if I had the crystal ball, but nobody has the crystal ball. But by diversifying and allocating to several, 2, 3, maybe 4, 5 strategies, diversification, you know that one year, one strategy or crediting method is going to be great. The other 2 or 3 may not be as good. But then the following year, maybe one of those other strategies is going to be the best one. And then the one you had last year that was best, maybe not as good. Blend, diversify, file that policy in your drawer and let it sit there, because you will see similar type returns, but you're also going to see less zeros on your statements, your client statements. And you know as well as I do also, those zeros, we know zeros are hero, right? We know zeros are hero, that saying, but does your client remember that zero is supposed to be their hero 365 days from now? No, they see a 0. And they know their neighbor or their wife that purchased the same exact product from you, maybe 2 days or a week in different times, they got a 5% interest credit, and your client got a 0. How could that be? Even though zeros are hero, you will have to explain and have the headache of explaining zeros to your clients. By diversifying, you're going to reduce those zeros substantially. So there's the accumulation story. It's simple. I spent probably a few extra minutes on it than I really wanted to, but if you have a client looking just for potential accumulation, as much upside as they can possibly get without that risk of losing their money, the VersaChoice is an excellent product for those individuals. Now, the second topic, so that was accumulation. Let's move on to the second topic of guaranteed lifetime income. And again, I know you all have clients that are looking for some form of guaranteed lifetime income, right? We can't rely on the government anymore. We can't rely on our employers anymore. So really the burden of planning for retirement and planning then for income down the road, it's lying, unfortunately, more and more squarely on the shoulders of your own clients and prospects. And who are they going to come to for advice and planning needs? Hopefully they're knocking on your door asking you for help. So how can we help those folks with the VersaChoice when it comes to guaranteed lifetime income? So this is not new itself, but your clients and you can add the optional guaranteed lifetime withdrawal benefits rider called the Income Pay Plus. So this is an optional rider, guaranteed lifetime income rider that your clients can add to their contract, the VersaChoice, at the time of purchase. This is not something they can add 3 or 4 or 8 years down the road. It has to be added at the time of purchase, and they have to be at least 40 years old to purchase it. Now, we know clients, and you know better than I, clients have a tendency to change their mind. Changing lifestyles happen down the road. If for some reason they add this rider at issue, and we'll talk about the fee, there is a fee for it. If they decide 2 years or 9 years or however long from now they don't need or don't want to use this anymore for income, you can remove the rider. You can take the rider off and you'll stop paying the fee. So it is revocable. Once you add it, doesn't mean it has to be on there forever and ever and ever. Once you add it, it is revocable. You can take it off, but you can't add it back on again, down the road. So once it's off for good. So real quick, I'm kind of like renewal rights. I want to get on my income horse here. You're going to find that the Income Pay Plus rider is not in every single scenario for every client going to provide the highest guaranteed lifetime income in the business. Now, you'll see on the screen, highest guaranteed income. That is with North American. This is our highest guaranteed income rider or product. But in the industry, in every scenario, every client, you're not going to find this is going to be the best one for every single client, every single scenario. No one company, no one product is going to be the best for everyone. But when you look at the gap, when you look at the difference really, and I don't know if you use some quoting engines or if you rely on IMS to do your quotes for you, but if you notice the difference between the top company for the highest guaranteed income and maybe the third or fourth or seventh, maybe even company down in order, the difference in that income for the most part is pretty minimal. I mean, if you're talking a $100,000 premium and you let it defer for 10 years and then start income, you might see a difference of anywhere from $50 to maybe $200 a month between the top company and the number 5, 6, or 7 company. There's not a huge difference. But when you look at some of the other features and benefits that might be provided from those riders, you might find there's some pretty big differences in other flexible options or features that are available within those riders. And I bring that up because you're going to find with the Income Pay Plus rider, it's actually got some nice flexibility and provides some other additional features and benefits that might not be available on some other companies or other riders out there. I also bring up when I'm talking about guaranteed lifetime income, there's obviously those three words are all critical, but to me, one of the most important ones in that guaranteed lifetime income sentence or quote, if you will, is the lifetime part. So obviously your clients, they're concerned about outliving their income in retirement. They want to be able to get paid some form of income for the rest of their life. That's what these things are all designed to do. Doesn't matter if it's the Income Pay Plus rider, if it's ABC Company's rider, they're all designed to provide income for clients' lifetime. Now think of that word lifetime, because if you purchase a guaranteed lifetime income rider with any company, we're no longer dating each other. When you talk about lifetime income, you're talking about marrying that insurance company. Your client's going to be more than likely with that company for the rest of their life. So think about that. Now, again, looking at the difference between number 1 company, number 6 or 7, you're also going to find some significant differences in ratings, financial strength. I feel that North American is one of the more financially stable companies in the business. I feel that we are probably one of the more conservative. We're all conservative, don't get me wrong, but I think we're probably a little more conservative than a lot of other companies out there. Again, you're going to be with that company for the rest of their life. So do your due diligence. Make sure that the company is as financially stable as you'd like them to be, that their ratings are as strong as you'd like them to be. And also, the one nice thing about North American when it comes to lifetime is, guess what? With the ownership structure that we have here at North American, we are an ESOP owned, we are an employee owned company. The way that our founders set this company up is your client statements are always going to say North American Company for life and health insurance. Even though we don't sell health insurance, it's in the name. I'm sure you've all been in the business long enough to see other companies being bought, being merged, being acquired, right? And maybe they bought their annuity 7, 8, 10 years ago and it was ABC Company, and 5 years ago, maybe now that company was bought and merged into this other company, and now their statements say this other company, and maybe they've been bought 2 or 3 different times. And you have to go through that type of a transition with your clients and say, hey, here, now we got a new company that's come in and bought this one. It's not a fun time at all. Lifetime income with North American means North American Company for life and health. Again, off of my high horse about the company now, let's get into some details about the Income Pay Plus rider. I mentioned you have to be at least 40 years of age at the time to add the rider. And I don't know about Marcus, but I can tell you, when I hear our sales desk, I sit right next to them. They take calls an awful lot on what do we have for lifetime income. One of the most common, actually the very first question I think that is typically asked is, what's the roll-up amount, or how much do you credit each year on that income value? So just quick 101 lifetime income benefits. With the Income Pay Plus rider, we are going to always have 2 separate values that we're calculating. On one side is going to be your accumulation value, right, based on the strategies you chose. That's going to potentially grow over the course of time. And on the other side, we have what we like to call, we call it the guaranteed lifetime withdrawal benefit value. Income Pay Plus rider, that income value is going to roll up by a compounding 6% interest for 10 years. It's going to roll up at 6% compounding for 10 years. And some of you might be thinking, oh, okay, Casey, well, you know, I'm gonna hop off the call because I'm selling a income rider that gives me 7% for 10 years, or I got an 8% simple for 15 years. We all are different when it comes to the roll-up amount. But keep in mind, just because one is greater than another one, and maybe it goes for a little longer period of time, doesn't mean that it's going to be the best one for your client. It may not still provide more income than another one. And that's because there's always two parts to these riders. Or you have the roll-up amount on the front end, and then on the back end, typically what does the company do when the client's ready to start taking income? They will look at and apply a lifetime payout percentage to the income value. That's another way companies differentiate themselves. And we'll talk about our payout percentages here in a minute, and you'll see that they are very, very competitive. So what's the cost, Casey? 1.05%. Your client's going to pay 1.05% of the income value deducted annually from the accumulation value. So we apply the 1.05% each year to the client's income value, and we deduct that resulting amount only from the accumulation value. The income value is only going to be coming down if the client's taking withdrawals or they've started income. That fee does not reduce the income value, it only reduces the accumulation value. But your client's going to pay that every year until this policy expires or the client passes away. So, and I'm sure, you know, these things have been around long enough. Hopefully we're just talking to clients about these riders for those that do need or want guaranteed income, because they're going to be paying that fee for the rest of their life. Okay, I mentioned just a bit ago too when I introduced the Income Pay Plus rider that there's some nice other significant features and benefits available here in the Income Pay Plus rider that other riders may not have. So we're going to go through at least 3 of these here in a little more detail. But when it comes to the payout options, the client has several choices. They can choose a level lifetime payout. They can choose an increasing payout. So if you have clients that are maybe concerned about inflation and the purchasing power of their retirement income, we'll talk about an increasing payout option. We also have a very unique feature called the LPA Reserve, and that provides some flexibility in the client's income, and we'll talk more detail. And I mentioned also very competitive payout percentages. You'll see that on the next screen. And then lastly, this is a penalty-free withdrawal-friendly rider, meaning if the client has to take a penalty-free withdrawal, let's say in year 4 for whatever reason, let's say they take a 3% penalty-free withdrawal, they still will get that 6% roll-up that year, all right? So if they take a withdrawal for whatever reason, they still will get the 6% compounding roll-up, just reduced proportionately by the penalty-free withdrawal. So just a little other feature available. So let's take a look at these payout percentages now. So I mentioned, again, there's always 2 parts to these riders. You've got the roll-up amount on the front end, which again, ours is 6% compounding for 10 years. And then when the client's ready to start taking income, that carrier typically has some form of a percentage or payout percentage that they apply to the value, income value, that will determine what is the actual lifetime payment dollar amount. You'll see the client has to wait till age 50 to start taking income. And then what we do is starting then at age 60, you're going to see that we bracket those payout percentages every 5 years. So Mrs. 65-year-old client, if you want to start taking income at 65 on a single person basis, level income, North American's going to apply a 5.2% payout percentage to your account value or to your income value to determine the actual income. Now, industry average at this point in time is less than 5%. I believe you're probably looking at 4.8 or 4.9% at age 65 5.20 is pretty darn good. If you want to take a joint income, I mentioned single income, level, and increasing. You can take joint lifetime income. That's going to guarantee lifetime income for both spouses. If you want to take joint income for husband and wife, that's going to reduce only 50 basis points. So our joint income reductions are only 50 basis points. And if you decide you want to take an increasing payout option, which we'll talk about here on the next screen, that's going to be reduced 1% from the single. So we went from 5.20 for a 65-year-old to 4.20%. Again, these are some very, very competitive payout percentages for lifetime income riders. And again, you're going to have clients that are going to say, that's awesome. I love the fact that I'm going to get guaranteed income. What about the purchasing power of that retirement income? Is that going to be able to keep pace with any inflation that might come about? And the good news is, if you have a client that is concerned about their income keeping pace, or the purchasing power and keeping pace with inflation, they can choose that increasing payout option. Now, we just saw the payout percentage is 1% less to start off, right? So here's a quick example. In this hypothetical example, we have a 55-year-old that starts taking income, and based on the premium they put in and the length of time that they deferred it, in this example, they're going to get $11,374 for the rest of their life, regardless of how long that is, right? If they decide they want the increasing payout option, at 55, their income would start at $8,666. And today, if this happened today, we would guarantee that that income would increase at 2% every single year for the rest of their life. 2% every single year for the rest of their life. So where does that 2% come from? Or how do we derive that number? Well, it's based on the current interest rate environment at the time the client starts the income stream. So again, today, if a client were to choose that option, we would guarantee a 2% increase for the rest of their life. 17 years from now, I can't tell you what the interest rate environment is going to look like at that point in time. What that means is, at that point in time, maybe that increase might be 4% per year for the rest of their life. It might be 1% a year for the rest of their life. It's based on the current interest rate environment at the time the client triggers income. So here's the good news to this, at least in my opinion. Think about, again, the interest rate environment we're in today. I mentioned earlier we've seen them coming up a little bit. With that said, we are still in a very low interest rate environment compared to past years. If we're able to guarantee a 2% increase for the rest of a client's life, even if the account value hits zero, even if they live to 146 years old, that payment's going to increase 2% a year every single year. If we can guarantee 2% in today's interest rate environment, I don't think it can get a whole lot worse. Contractually, it can. Now, once the policy is issued, again, once that client starts taking income, that guarantee is stuck. We can't change that increase 16 years from now or 34 years from now. That client's going to always, in this example, get a 2% increase. So if you have, again, clients concerned about the purchasing power of their dollar and keeping pace with inflation, have them choose the increasing option. And I get that question a lot too, as well, Casey, which one's better? As you can see, at a 2% increase every year, it takes just under 15 years for that increasing payout option to actually catch up to where the level payout option is. So here's a couple of things you have to keep in mind as far as which is better, the level or the increasing. Every client situation is different. Every scenario is going to be different. You have to look at each one separately. If you've got a client that's got longevity in their family, grandparents, great-grandparents, uncles, aunts, all lived to, 104 or 96 years old, I would probably choose the increasing payout option. Yes, you're going to start lower, but over time, you're going to catch up to and pass that level payout option. On the flip side, if your family history is, heart attacks and cancer and deaths, nobody's lived past 75 or 80, depending on when you start taking that income, you may be more of a candidate for the level payout option. Every situation's different. Now, once you trigger income and you choose the level or the increasing, you're stuck with that. You can't change it down the road later, okay? Here's one other thing I do want to point out is when do you elect to choose either a single income or a joint lifetime income or a level or an increasing income option? When you're ready to start taking income. You don't have to decide at the time you buy this thing. Let's say you're 50 years old. You don't have to decide at 50, you know, I plan on taking income 15 years from now. Well, I'm going to do a level and I'm going to do a joint income. Circumstances may change, so you don't lock anything in until you're ready to start taking that income stream. So some nice flexibility. And talking about flexibility, let's quickly cover this LPA reserve account. Think of this as, I like to also think of this as kind of a bank account, okay? Think of this reserve as a bank account. So here's how this works. Keep in mind that as the name implies here, the Income Pay Plus rider is an optional guaranteed lifetime withdrawal benefit rider. So pretty much when we look at any of these riders, it doesn't matter what company you're with, these are all withdrawal benefits, meaning this is not annuitization, right? We think of, we're familiar with the term of annuitize, you know, and you get lifetime income when you annuitize a contract. Well, when you annuitize a contract, that income is set and you can't start and stop it, right? Once you annuitize something, you're going to get that same income stream for however long it is. These are withdrawal benefits, and what that means is you can start and stop this income stream anytime you want to. If your lifetime income is, say, $20,000 a year, do you have to take the full $20,000? Absolutely not. You can take $10,000 if you want to for 5 years. When we quote and provide those payments and tell you this income will provide a lifetime income of $20,000, that's your guaranteed worst case scenario is what you're going to get for the rest of your life. That doesn't mean you have to take the full $20,000. That's where this reserve account comes into play. And what it does is it gives your clients some flexibility to plan for either unforeseen circumstances down the road. You know, maybe they're concerned about some health issues that might come about. They want to make sure they have enough money set aside if one of them has to do some assisted living or they have to spend some time in rehab or a big emergency room bill. I mean, the unexpected things. But it also gives them the flexibility to plan for foreseen circumstances. Maybe they want to help pay for a grandkid's college education, you know, 8 years from now, 12 years from now. This reserve gives them the flexibility to do exactly that. So let's go through this example. I know it's kind of discombobulated here on the screen, but in this example, Ed, when he's ready to start taking income, his lifetime payment amount, we tell him based on your value at this time, based on how long you've been in this thing, and your age, Ed, we're going to pay you $18,000 a year for the rest of your life. I'm sorry, let me backtrack. I'm looking at this screen here. The light green one is Ed's guaranteed lifetime payment amount. Ed, we're going to pay you $12,000 a year, worst case scenario, for the rest of your life. Ed thinks, you know what, that's good. I like it. I can use it. Let's go ahead and start taking income. Well, Ed decides for maybe the first couple of years that, you know what, he maybe doesn't need the full $12,000. So instead he says, you know what, let's start off by taking half of that. Just give me $6,000 a year, and let's do that for a couple of years, all right? So for the first 2 years of his income stream, Ed, instead of $12,000, takes $6,000 each of those 2 years, which means he's now in his reserve account, he's banked that excess amount that he didn't take, which in this example would be $12,000. He would have sitting in his reserve account. So what you don't take goes over into this reserve bank account. And just like a bank account, you're going to get no interest on this reserve account. This is simply a holding tank for the excess withdrawals that are the amount that you didn't take of your lifetime payment amount. So it's not an interest-bearing account, all right? It's not going to earn interest. It's a reserve that sits over here that you can utilize at a later date to either take more than your guaranteed lifetime income amount, right, for a couple of 2 or 3 years. So here, real quick, Ed takes 6,000 instead of the 12, banks that other 12,000 total amount, and then in the 3rd year of his income stream, he says, you know what, I want to do some touring. I want to go on some vacations. I want to take some cruises. So now, Ed, instead of 12,000 a year for the next 3 years, you can take that reserve account at basically $4,000 or $3,000 a year. So we'll pay you $15,000 for the next 3 years, and then it'll drop back down to your $12,000. So again, some nice flexibility, right? And Ed, in this example, let's use this one. This probably happens or will happen a lot, and that is, you know what? I want to help pay for my grandkids' education. So instead of $12,000 a year, which he could take for the first 3 years, Ed takes, I think this is, let's just say it's half. It's $2,500 a year for 3 years. And then guess what? In the 4th year of his income stream, Ed now has sitting in his reserve account $37,500, right up here in this purple line, that he can take out one time, and he writes a check and he pays for his granddaughter's private college tuition for that year. And next year, Ed can take as, again, $12,000 a year if he wants to. So this is a nice feature to give that client the ability to plan for those foreseen or even those unforeseen circumstances. So real quick, I got 2 quick case studies and we're done. The first one is just a simple 55-year-old client that puts $250,000 of premium in the VersaChoice product. They purchase the Income Pay Plus rider at 1.05% fee. They let that defer for 10 years, which is the maximum on the Income Pay Plus. And then at age 65, they start taking that guaranteed lifetime income. Mrs. Client, based on those numbers, at age 65, and I apologize, this is somewhat small, North American is going to guarantee you $23,281 for the rest of your life. And they can see that it goes out for pretty much ever, because even here on this side, the account value hits 0, but that lifetime income just continues to get paid out at $23,281 or 91. I'm sorry, I can't quite read it myself. A very typical client, right? 55-year-old puts money in, defers for 10 years, starts taking income at 65. Pretty common. Now here, to help kind of show that reserve account, same 55-year-old, all right, putting the $250,000 in, they defer for 10 years. The first 4 years, they decide, you know what, we want to help pay for the grandkids' college education. No, I'm sorry, let's reframe. The first 4 years, they say, you know what, we don't need the full $23,681 or $23,281, whatever it is. Just give us half of that. That's going to suffice for the first, 4 or 5 years. Then, starting in that 5th year or the 6th year, then what we want to do is we want to start helping pay for that grandkids' college education. So let's give us the full amount at that point in time. And you'll notice here, so here's the 50%, $11,641. Then it bumps up. And look over here to this on the illustration. You'll see this LPA reserve account, right? So they took half of it, so they banked the other half. Next year they took half, so we just add another $11,641. We add another $11,641. So you'll see that their reserve account at this point in time is $46,000. So at any point in time, they can choose to dwindle that down by a little bit each year and take more than their $23,000, or maybe they have a medical emergency in this year here, and their doctor bills $40,000. Well, here, take out $40,000 from your reserve account. You're still going to get $23,000 for the rest of your life. It's a pretty interesting, pretty unique feature that we have available within the Income Pay Plus rider. Here, I'll just blew that up a little bit for you, make it a little bigger. So with that, folks, let me just quickly summarize. We talked about accumulation, right? And with the rates where they're at on this product, with the uncapped strategies that are available within this product, you're going to see the VersaChoice is an excellent accumulation product. We just talked about guaranteed lifetime income. We have a competitive roll-up on the front end, 6% compounding for 10 years, and we have some of the most competitive payout percentages on the back end. And also the additional flexibility with this reserve account. There's, I think, maybe one other writer out there in the industry that offers this type of unique feature. But again, flexibility to plan for the future, foreseen and unforeseen circumstances. Now, Casey, that's great. Hey, I like what I heard. So, you know, what's in it for you? What's in it for your clients? What's in it for you? Well, for your clients, I mean, guaranteed lifetime income, strong, stable company, great accumulation opportunity. You're going to have some happy clients. And typically for you, what do happy clients usually do? They typically refer other happy prospective clients to you. And more opportunities for you means more sales and income for you as an advisor. So I mentioned your one piece of homework at the beginning. You've got one piece of homework now here at the end. Well, first of all, I hope you each have 2 or 3 names of clients or prospects that you think this might be a fit for. Here's your next piece of homework. On your next either potential accumulation sale or potential lifetime income sale, I want you to either call IMES, call your marketer at IMES and have them quote the Versa Choice product, or call our sales desk here at North American and we'll quote it for you as well. Give us an opportunity to earn some of your annuity business. And with that, Marcus, I have us, man, right just short of the top of the hour, my friend. I'll turn it back over to you for any closing comments or remarks. And again, I want to thank each of you for taking time out of your busy schedule and away from your own clients and prospects to join us here today on our webinar. Marcus?
Thanks, Casey. I certainly do appreciate it. Appreciate your time today. I'm going to just throw a poll out there. If you'd like some information and contracting for North American, please go ahead and answer the poll if you would. I appreciate everyone's time this morning. If you do have some questions, please go ahead and type them in the screen. Casey or myself would be more than happy to answer them for you at this point in time. So I'll leave that and the poll open for you. I don't show any questions out here, Casey. So again, I do appreciate everyone's time. I will be following up with each and every one of you this morning to see if there are any additional questions or see if there's any type of proposals I can put together for you for any upcoming appointments. Keep in mind our Life and Annuity Academy, our industry recognized event, is coming up here in September. I can get you out information on that as well, but I do appreciate your time this morning, Casey. Thank you. And thank you to everyone who and took time to spend with us this morning on the new product launch, and I'll look forward to talking to you soon. Thanks, Casey.
Thanks, Marcus.
Have a good day, everyone.